Hello, my name is Yuya Shimizu, the CIO of Hibiki Path Advisors.
We are value and engagement oriented investor investing into small to mid caps of Japanese equities. Today, I would like to introduce our recent proposal letter to a company called Kinden. The code number is 1944. It is one of the major electrical engineering and construction company, and we believe the stock price is deeply discounted to its intrinsic value. So we are making our position clear what is required to raise its corporate value, and for what it's worth, we would like to share it to other shareholders as well as all the market participants. Okay, so here we go. So let's start with the introduction of Kinden's business. So, in one word, Kinden is an engineering construction company, and it specializes in electricity. And it's one of the top players in the industry, with revenue of around $4 billion and market cap of around $3 billion. Kinden's valuation is very cheap in our view. It trades at around 2 times EV/EBITDA, and price to book is about 0.7 times, although it is one of the most profitable, most stable company in the industry. Kinden has been established as a subsidiary of Kansai Electric Power, and it's still Kansai Electric Power still owns 29% of its equity. But the revenue from Kansai Electric Power is only less than 20% of its total sales, which means that Kinden has been able to diversify their business away from its parent company using its value add to its clients. The outstanding thing about Kinden is its earnings power. It has a very strong and stable cash flow, and it has never had negative profits in the past 20 years. And that's one big reason behind why it has such an excessive balance sheet, and we're going to touch on it later. So if you can read the actual proposal letter, you can see that it's structured in 3 segments. One is about our intrinsic value calculation. The segment 2 is about the Kinden's issue, which apparently is their balance sheet. And the last part is about our 2 proposals. So let me just explain briefly on those each segment. Part 1 about our intrinsic value. So we usually use a very simple DCF valuation. So based on this, intrinsic value per share is about 4,900 yen in our view, which is actually more than double the current share price. We use very simple parameters. Free cash flow is about 35 billion yen, which is slightly less than the past 5 years average. The weighted average cost of capital is 5% derived from the CAPM calculation, and the terminal growth rate is 0, which I believe is quite conservative. So we believe there's huge margin of safety in its current share price. In section 2, we touch on the issue about their balance sheet. Most apparently or significantly, we can see that of the 740 billion yen of their total assets, nearly half is consisted by cash or investment securities. And if you look at the other side, interest-bearing debt is a mere 15 billion, so it's almost 0. So this is the result of their strong business, and the past payout has been very small to its shareholders. We can see that its shareholders' equity ratio is around 71% of total assets, which is, of course, it's an excess capital situation. So, if you look at the past 5 years return on invested capital, it's around 14%, which is quite healthy actually. But return on equity is only 6% over the same period, and embarrassingly, it has never gone over 8% threshold mentioned in the Ito report for the past 10 years. So, not surprisingly, price to book has never reached 1 time. So this is the issue of Kinden's balance sheet and its valuation. Based on such analysis, our two proposals are quite simple. Proposal 1 is to implement an M&A strategy to fund growth. Proposal 2 is to raise the total payout ratio to 150% for at least 10 years. And these two proposals are connected to each other. It is basically a discussion of capital allocation. If you have not thought about capital allocation, you just keep everything on the balance sheet, and that's what it looks right now. And we are suggesting to the company they need to think strategically to utilize their value that's on their balance sheet to fund either the growth of the business or to raise the value of the share price. I think this is nothing antagonistic to its current management, and we believe it is a constructive, forward-looking proposal and very reasonable proposal. If you look at proposal 2, payout ratio of 150% looks maybe a bit excessive on surface. But if you read this proposal letter, you can see that it's very reasonable. The point here is that based on our simple assumption and simulation, we believe that if you continue this 150% payout ratio, two things can be achieved. One is the balance sheet, net cash balance sheet, is still going to be maintained after 10 years. So there's no debt. Balance sheet remains to be very strong. The point 2, at the same time, return on equity will rise to above 13% level, which is sufficient enough probably to raise the share price above price to book of 1 time. So still very healthy balance sheet and higher return on equity. There's nothing much, to lose for the company. So we believe it is a very reasonable proposal, and companies should take it very seriously. As a side note, we also introduced a case study, a good example announced by a company called Toyo Seikan Group in May this year. If you look into the link here, you can see that they talk a lot about this return on equity, cost of capital, price to book, these things, which has been asked by Tokyo Stock Exchange. And what's most outstanding here is that they admit that their return on equity has been lower than their cost of capital for many years, and that they need to change that. So the conclusion is very simple. In order to change this, they're going to reduce the capital by paying out more than 100% for the next 5 years. And of course, market took this very positively. And guess what? The next page, the stock price has risen more than 30% since its announcement, while the market has been rising somewhere around 10% over the past few months. I also had the impression that this is very strong and decisive announcement by one of the very old school company in Japan. And I'm excited with these changes happening. And I truly feel that Kinden's management also need to learn from these changes where very traditional companies' management are making. So lastly, here's the summary. We love Kinden's business, very stable, very profitable, and they are the leader in the industry. But they need to change the balance sheet management policy. And based on that, we have made 2 proposals. We have been saying this change in the balance sheet policy for many years, and the obstacle for this was the huge cross-shareholdings piling up on the balance sheet. We recently publicized a thesis paper called 6 Recommendations in our website. Actually, we have sent this out to all of our portfolio company CEOs, and we have started discussing this with the management, including Kinden's management. So, we will continue to engage with Kinden in order to realize the value together. I am very happy if other shareholders and other market participants read our paper and then utilize this letter in any ways you can to engage with the company respectively. So it was the introduction of our proposal letter to Kinden. Thank you very much for listening. This was Yuya Shimizu, Chief Investment Officer of Hibiki Path Advisors. Thanks again. Bye-bye.